Hello, everyone. We hope everyone is staying safe and healthy. In these extraordinary times, we thought it may be helpful to share some insight that we have been gathering from our partners in the marketplace and from you, our clients. To do this, we're pulling together some of our practice leaders within the firm. And today I'd like to introduce Kate Peasy, who is a senior consultant in our defined benefit practice and a reformed actuary. Kate?
Thanks, Ryan. So without a doubt, markets have been incredibly challenging. I think that's really an understatement. We have seen swings in one day that have total returns that we've seen for an entire year, and that's really not been isolated to equity markets. Spreads, or the additional yield demanded from investors to invest in a corporate bond instead of U.S. Treasury bonds, have increased to levels we really haven't seen since the 2008 financial crisis. And the speed of the increase has been nothing short of remarkable. On Tuesday's close, the yields of high-quality long corporate bonds were at 3.56%. And on slide 3, you can see just how fast and sharp this move higher was, from 2.65% at the end of February, or an increase of 0.91% in just 23 short days. I mention this because for pension liabilities, they are discounted or valued using long corporate bond rates. As rates go up, the value of liabilities goes down. So it's certainly an important piece of the pension puzzle to be looking at. Now, if you look back, the current level at 3.56% that we're at today brings us back almost exactly a year. So the last time we've seen this level was about 1 year ago. Now think back that 1 year, that's when the S&P was up 13.6% for the first quarter alone, really as we roared back from the government shutdown, a reduction in trade tensions, and the Federal Reserve's kind of about face. All of the good old days of things that we were concerned with outside of a global epidemic. So what does that mean for companies that sponsor a defined benefit plan? So although yields increasing decrease the value of the bonds in the portfolio, the increase, as I mentioned earlier, is actually good for the liability side of the pension equation. And you can see what I mean on slide 4. So in the upper left-hand graph there that I'm showing, the blue and the gray bars represent the corporate bond yield. And you can see from February in light blue to gray in March represents that increase that I have been talking about. For a shorter duration liability, so that first set of bars, about 13.5 years of duration, that equates to that increase in that discounting rate from the interest rate environment equates to a decrease of those liabilities by over 12%, shown in the orange bars. Now, if you have a longer duration liability, so perhaps you have an open plan and the duration is closer to 17 years, that increase in that corporate bond environment, or that discount rate that's used to value that liability, equates to a liability decrease of nearly 15.5%. So for plans that are not fully funded, this means that the pension fund could withstand a decrease even greater than those liability gains before the plan's funded status shortfall, or that assets minus the liabilities, decline further from where they were at the end of February. Unfortunately, however, equity losses have totaled much more than those liability gains in March alone. We estimate that the equities losses have outpaced the liability gains by about 5%, which translates to a reduction in the average funded ratio of about 4 to 5 percentage points in March. So to bring a bright spot to this environment, and I mentioned earlier, this changes day to day. Yesterday, the equity market was up nearly 10% across the board. So certainly helping our pension clients as well as all of our clients when we see the equity return so strong in one day. So we are monitoring the situation closely for all of our clients. At this point, we advocate for remaining committed to your long-term strategic allocation, but are encouraging our clients to consider rebalancing, even if at least partway back to targets. We have also received a handful of questions from our clients on re-risking their pension plan. We believe this should be considered very, very carefully and thoroughly, fully recognizing the risk and the potential outcome should markets move lower after re-risking. With a significant amount of uncertainty, any changes in the long-term strategic allocation in this time of heightened uncertainty and volatility really should be approached with care and utmost diligence. So with that, I want to thank you for your continued trust and partnership with FIA in this extraordinary time. Be well, stay safe, and remember to keep the full pension picture in mind when you think about your pension investment portfolio, and remind yourselves to keep the long term in perspective. Thanks, Ryan.
Thank you, Kate. Great insights. We hope to do these each week as the market continues to change and evolve. So to that end, if you do have questions for Kate or any of our other pension specialists, please send them to the email address you see on the screen. In addition, please feel free to reach out to your consultants and service teams in the event that you have specific questions related to your pension plan. That's all for now. Please stay safe and healthy. Thank you.